An IPO situation more closely approximates a negotiated deal. This quote by Warren Buffett helps us understand and get a perspective on what an IPO truly means. Hi guys, it's me Vedant, and in this video we're going to discuss about IPOs, something that has been on the buzz since the last 1 year. Let's try to understand them and dig a little deeper. I have divided this video into 5 sections. The first being, what is an IPO? Second, why do companies go public? Third, how do companies go public? Fourth, analyzing the risks and rewards in an IPO. And lastly, concluding with a discussion on valuations of IPOs. So let's get started. What is an IPO? An IPO stands for Initial Public Offering. As the name suggests, it is the event when a company sells its stock in the public markets for the first time. The company goes from being privately owned and comprising of few investors to now being owned by lakhs of investors. The company would now be answerable to all of these new shareholders and would have to also make a lot of information open for everyone. This is because the public would never invest in a company without actually having good details and information about it. This would mean even the competitors would now be aware of this information. So the question naturally arises, why would a company go public? The primary objective of launching an IPO is because the company can now raise a lot of capital. They can raise a lot of cash by selling their equity to the public. This would mean that they can use this money for future expansion plans, reducing their debt levels, and also providing exit, or basically allowing early investors and investors otherwise to liquidate their investment and convert it into cash. This brings us to the next segment. How do companies go public? For you and I to trade stocks in the market, we need an intermediary called the broker. Similarly, companies also require an intermediary in such large and complex transactions. Investment banks act as these intermediaries for companies. It is the investment bank's responsibility to analyze the financial statements, to gather all the historic data and compile all of the information regarding the company into one report called the RHP, or the Red Herring Prospectus. The RHP is the document which should explain to us the entire business of the company, its past track record, and also its future expansion plans, including what the money from the IPO is going to be used for. This document is now made available to everybody. The investment bank now analyzes the responses from investors and how much interest they are taking in this IPO. Based on this, they set something called a price band, a fixed range of price for one share. The stock of the company is sold in this fixed price band range only during the IPO. The investment bank's job is to essentially help the company raise maximum amount of capital from its IPO, and therefore they also fix the best possible time for launching the IPO. During an IPO, money can be raised through two different means: offer for sale and fresh issue of shares. Well, I found an article which explained this difference very well. I'll link that in the description box. Make sure to check it out. To give you a rough idea though, in offer for sale, the promoters or the owners of the company sell some of their equity to the public, and therefore the money gets exchanged between the owner and the public. And the money that is now given to the owner is expected to be used as promised in the RHP. In a fresh issue, new shares are introduced and sold to the public. If there were initially 100 shares that were sold to the public, now there will be 50 more shares, for example, that are sold to the public. The major difference being that the money that is now raised goes directly to the company. It is owned by the company and not by the promoters. Now let's come to the fourth segment, analyzing the risks and rewards of an IPO. IPOs are generally launched at a time when markets are booming and there's a lot of enthusiasm. It's very easy to get caught up in the hype and neglect the fundamentals of the company. We have in fact observed this in the past 1 year the markets have been performing exceedingly well and filled with enthusiasm. During this time, 1.2 lakh crore rupees was raised through IPOs, which is 4.5 times more than the previous year. There were 65 IPOs that were launched in 2021 as opposed to just 15 in the year 2020. It is important to keep in mind that an investor always aims to buy low and sell high, but in an IPO situation, the company is trying its best to sell as high as possible, which conflicts with the interest of the buyer, which is the investor. Let's take a look at Warren's quote again on IPOs. An IPO situation more closely approximates a negotiated deal. I mean, the seller decides when to come to market in most cases, and they don't pick a time that is necessarily good for you. Well, here Warren Buffett is saying the same thing. He's calling this a negotiated deal because a lot of the terms of this transaction has already been set by the seller, which is the company launching its IPO. They decide in what price band they are going to sell, and they also decide at which point of time they sell. Another problem that common retail investors like you and me face during IPOs is that the good IPOs generally have such a high demand and have such a high oversubscription rate that getting the IPO allotment becomes very difficult and close to impossible. Another risk with IPOs is that they often do not have a very well recorded past, which makes it difficult to get a complete picture and proper understanding of the business. Now let's come to the rewards and advantages that IPOs hold. The one key advantage of IPOs is that they often by and large give a very good short-term positive return. Of the 65 IPOs that were launched in year 2021, 45 gave a positive return before the year actually ended. One of the parameters which can be used to gauge whether an IPO is going to have a good listing gains or going to give a positive return in a short term is by looking at the GMP or the grey market premium. The grey market is an unofficial but legal market where the IPO shares start trading even before the actual launch. Suppose in an IPO the value of one share is 100 rupees, but in the grey market before the launch it has already started trading for 120 rupees. This would make the grey market premium 20%. This grey market premium that we are referring to can actually help us guess whether the IPO is going to be a success, whether it's going to give large listing gains or not. However, this is not absolute. It can only be one of the parameters that we consider. One of the ways we can improve our chances of getting an IPO allotment is by applying for the IPO through different demat accounts that are linked to different PAN cards. Now let's come to the final segment, which is discussing the IPO valuations. In this part, I'm going to discuss the reasons for which IPO valuations could be inflated. As we have discussed many times earlier in the video, IPOs are often launched during booming markets and people easily get caught up in hype and the valuations tend to be very steep. Another reason why IPO valuations could be inflated is because we use private valuations as an estimate and to guide us during the IPO valuation. Companies also raise money through private funding before launching an IPO. They go to venture capital firms and different investors to raise money. The thing, however, is that these investors, the people investing in private companies, often get a lot of preferences and lot of perks. Let me give you an example of one such perk. For example, the liquidation preference. Certain shareholders could be first given their capital back in the case that a company is going bankrupt, and only then the rest of the shareholders are attended to. Private funding players often don't mind paying premium valuations but also keep their provisions and different optionalities to use to their advantage. The problem is during IPO valuation we use these premium valuations to again get an estimate, but these valuations do not make sense always. This is because the common stock, the equity that is going to be sold to the public, is not going to have any such conditions or options or provisions. Private limited companies do not have to stick to very strict accounting principles like the public companies. This gives them greater flexibility to manipulate their financial statements and show inflated profits. This again leads to inflated valuations. This is why private funding could give us a bad estimate for IPO valuations, but they are used either way. That's it for this video, guys. Make sure to smash the like button and